We've got 6 of the most brilliant and important folks in the Austin startup community up here. So we're going to do it casually in the sense that, as you can imagine, we could probably talk for a couple hours. And so what I'd like to do is just jump right in. And I'm not going to introduce them. We'll just get to know them as we talk tonight. Why am I up here? I do a lot of work with a passion for venture capital in particular. And so when Reza shared that they wanted to do a talk about the venture capital ecosystem, what I wanted to share and focus on was the idea that for Austin, there's an incredible distinction between angel money and crowdfunding and convertible debt, raising money from a bank, and what these folks do, right? What venture capital funding does. And so I encourage that we focus just on venture capital funding. So that's what we're here to talk about tonight is how these organizations work, how these funds work, the role that they play as a service provider, right? As a resource, as a team of experienced folks that have been through this before, have been in your shoes to some extent. And they're here to help be a catalyst for this ecosystem. And hopefully tonight we can talk about how and why. To do that, since it might be a bit of a long chit-chat with so many of us, we're going to break it up into 3 sections, okay? We're going to break it up into 3 sections, take a little pause, because we're going to produce tonight, and we're going to foster Q&A online after tonight, okay? We're going to produce some video, we're going to produce some articles about what we're talking about. We're going to give you the chance to connect with everybody through some questions and answers later, so that this doesn't run into a 2-hour talk while everybody's asking questions tonight. So we're going to break it up into 3 topics. What I'd love to talk about first, guys, and for you to introduce yourselves, first we're going to talk about how venture capital funds work, right? What is it that you do? Let's not yet talk about how these folks find you, how they pitch you, how to raise money. Let's not yet talk about what's going on in Austin, because in my experience, the challenge of raising capital is often about understanding your role, right? Understanding your expectations, your business, and the way that you guys operate. Then I'd love to talk about separately, I'd love to talk about what's going on in Austin. So we'll talk a little bit about the Austin industry, the ecosystem, what's exciting here. This is a good example of what's exciting here, right? If you need any more assurance that you guys should be a part of Team Austin, the last event was as exceptional. We had Hugh and Jay and Kristen from South by and Everfest and Do Stuff Media talking about Austin's event industry. I mean, so Team Austin has done an exceptional job of pulling together some great folks to talk about this industry and this ecosystem. So let's talk about Austin second. And then third, right? Third, we'll talk about how to reach you, when to talk to you, how to pitch, how to raise capital, when the right time is for an engagement with you guys and so forth. Sound good? All right, so first, explain to me what you guys do. And I'm not going to talk much more. My job, especially with you guys up here, is just to move us forward. So explain to us, and let's have a conversation about what you guys do. How does a venture capital fund work? And why is that different? Because I think it's important. Why is that different from an angel group or an angel investor or a crowdfunding solution, or what have you? Rajiv, you want to kick us off?
Sure. Is this on? Okay, great. So what is venture capital? We all go out to a group of investors and find pools of capital. So our current pool of capital that we're investing out of is $75 million. This is our 6th one. We have $350 million total that we're currently investing. And we get that money from those investors and then invest in great companies, help them grow, do a lot of coaching, getting the right folks in place, and a number of other things along the way. And then when we sell those companies, we get paid basically a percentage of the upside, and our investors get a majority of that upside. I'll stop there.
So it's your job.
It is our job.
Right?
Yeah, we're done.
It's that simple.
No,
it is that simple, right? But you guys are raising capital, so talk a little bit about that, right? How do you find the money? Where
do we get the money?
Yeah, sure.
Yeah, we have to do the same thing entrepreneurs do. So I'm Tom Ball. So I'm with Next Coast Ventures. We just raised a $90 million fund in March. And how do we get money? We go out and ask people for money, just like you guys do. There's a multitude of groups you can get money from: traditional investors and venture capital funds called limited partners, institutional investors such as big state institutions, pension funds, corporations, and then you can go down the stack to high net worth people, family offices, and we just go out and pitch them. We have a strategy of how we want to invest, how we think we can make them money better than other ways they can make money, and you try to convince them to give you money to invest in things like Rajiv.
I mean, that really is straight up it. We're going to be less and less value add as it comes down with the same question, right? So
make sense, right? If you're getting paid, as Rajiv pointed out, right? You're getting paid to operate these funds. You
I think,
guys are in a sense companies, right? And are there employees?
well, I think that's a big thing to talk about that. So there's a difference between being a fund manager and running an operating company. I've done both, and most funds don't operate like operating companies, right? You're a custody, you have a finite life, right? You have rules, you have finite capital. It's a constrained business model versus like an operating business. Sky's the limit. Do whatever you want. Dial it in, dial it out, right? You can't really maneuver outside of your 10 years that we have. We have 10 years to take money, put money out, grow companies, exit companies, and we have a couple sort of mulligan, like we can extend. But after that, that's it. So then it's game over for that fund, right? So just know that we have constrained rules. You may hear like, my VC's pushing me to exit or this or that. Well, it's because we have rules, right? So just know that going in. I'd say that's the one big difference about it. The other thing too is, since it's a finite bucket of cash, you can't just scale it on up and hire people, right? There's a certain amount of OpEx you can deal with based on the fees that we are able to generate, and you have to work within that budget. So we're the smallest of the fish in the venture capital space. So it's Class C office space, and nobody's got new suits on. So we're the sort of the feeder team for the major leagues, if you will.
So in feeding up, right, it helps distinguish that there are different folks in the ecosystem, the angel investors, crowd platforms, the banks. And Chris, you pointed out that you have a fund, and the fund has a life. So what happens in operating these funds when you're raising capital, when you've just raised capital, or when you're at the end of the life of a fund, when you need to start raising capital again? I mean, let's get a little bit deeper on the implications of the fact that you're managing other people's money. And do your expectations, does your role change depending on where you're at in the life of that fund and the fact that you might need to go raise more money or might be done with the fund? Tell us about how does an entrepreneur appreciate the stage that you guys are at in the funding you have available?
Oh, that's a lot. Midway through, I thought this is the place to be to take the easy questions. So Krishna Srinivasan with Live Oak Venture Partners, we are currently investing out of Fund 1, which is a $108 and change million fund. Funds typically have a life, yes, and because LPs make a capital commitment to you, they don't, when you go raise $108 million, they don't wire $108 million sitting in a bank account. That's not happen. So we make what is called capital calls. Whenever companies come up to invest, we expect when these things need to come, and we reach back to our investors and say, hey, I need this chunk of money. We don't necessarily tell them what we're going to invest in, but we need this much amount of money, and and then magically capital shows up because that's part of the commitment, formal commitment they made to the fund. And so we are governed by, when we raise the fund, we sign what is called an LP, limited partnership agreement, or an LPA, which we are signatories along with all our investors. And as a part of that, typically you have, people talk about funds having a 10-year life, or which extendable by a couple of years and perhaps more on a discretionary basis. So LPs need to think about how long you will be calling capital down from them. And typically, we also have, we do new investments only in the first 5 years of the life of a fund. So it's called the investment period. So the first 5 years, you do new investments, and then you do follow-on investments subsequent to that along the way, and you hope to be done with the fund in the 10 plus 2, 12 years of it. But more often than not, it takes longer than 12 to completely wind up a fund, and that's a difficult couple of issues. So you should always be aware of where is that fund in its life with respect to when there is a fund. As you pass the investment period, they're unlikely to do new investments unless they have a new fund. And later in the investment period, maybe not do a super early investment are all factors that go into these things. And we are all, get into a cycle of raising a new fund. And when we look to raise a new fund, our LPs are looking to say, did you guys do what you said? Are your portfolio companies tracking well? Do you have returns? Are these growing and doing well or not? Those are the factors that go in before they end up re-upping or come back in for a next fund. It's just part of a complex sales process to these institutional investors. You can go on and on and on, but I'll stop here.
Well, I do think, is this a valuable line of questioning? Because, truly, when you're raising capital and you're trying to figure out whether or not you just list yourself on angel list, does that work, right? Or do you go talk to Clara at CTAN? What's that process? Or do I find the right set of angel investors, right? Or how do I know whether or not to talk to you guys? Morgan, to steer you a little bit, I'm particularly excited to be up here because when I moved here 7 years ago, the very first VC I met in town was Morgan Flager. And it was at an event that Kevin Coyne was hosting about venture capital at Tech Ranch. And Kevin is here tonight. I think he's still here. And Kevin is now working with Impact Hub as well. So it was kind of neat running into Kevin in the back and then knowing Morgan and I were going to chat up here. Right, you've been at it for a while. How does the process of engaging with you guys work? Right, there are other folks involved. Right, is it just calling you up? Is it just having coffee with you guys? Do you have a team of people? What do folks do to connect with y'all outside of showing up at events? Let's go there.
Sure. I guess a couple of things just before we kind of dive into that. A lot of people, like venture capital, I think as an asset class and ecosystem has kind of evolved. I mean, I think it used to be the case that, people would kind of have to come talk to us and it was kind of like, they didn't really want to. It was kind of like, I need money and these guys have money, so like it's a necessary evil and I'll go like kind of kiss the ring and talk to VCs. And I was talking with John Mackey, who is, a Whole Foods founder, and he called VCs hitchhikers with credit cards. and what he meant by that, which I thought was hilarious, was, hey, you tell them a story of where you're going to take them, and they get excited about that. And as long as you're going there, they'll pay for gas and snacks and maybe even get you a hotel room. But like if you ever decide you don't want to get there or the car breaks down or whatever, they try to like throw you out and like hijack the car and like drive there anyway, which is kind of like how he came up with that analogy. And to a large extent, I think depending on who you work with, maybe that was the case. I mean, I think it's evolved a bit in terms of like it being more of a service business. So, we're not just money managers like that are bridging the gap between, an LP and who wants to invest in these kinds of companies and you guys. I mean, really, the successful VCs are partners in helping to build companies. We want to help you recruit, help with strategy, share some of the wounds that we've had to avoid you guys having to do the same stuff. So the successful folks are kind of the people that embrace building companies and doing that thing versus just kind of, my role and goal in life is to pick a good company and then kind of stand back and watch magic happen. So with that having been said, I mean, I think the best way to engage with VCs is to kind of figure out kind of which is which. And the best way to do that is get to know folks early, before you're raising money. Tell them about your business, see how they react. Are they asking intelligent questions? I think it's fair to ask them, if they can help out in some way, especially if they're connected to someone or doing something that could be helpful to you, and then actually see if that was helpful and they deliver on it. Like a lot of people promise stuff and nothing kind of ends up kind of happening out of that. And if they do that on the front end of a relationship, that's probably indicative of kind of what might happen later. So it's due diligence both ways. It's meeting people in advance and then figuring out kind of if they have reservations on the business, what are they? How do you get comfortable with those things, trying to make progress against those, and then reporting that progress back, such that obviously by the time you actually need the money, you'll have hopefully like mitigated some of those things and gotten to a stage that they're comfortable with and can kind of go forward from there.
So begs my last kind of thought about how you guys operate, and it's whether or not you can characterize what you guys really look for in an entrepreneur and in a business, right? Given the fact that you to some extent have to deliver a return, whatever that return might be to your investors, and you've got to fund yourselves, right, and build these organizations that can continue to sell and raise capital for the ecosystem. So Matt, give us a sense for how does the audience, how do we know when a venture capital fund is an appropriate conversation versus thinking about alternative sources of financing?
Yeah, so I think Morgan hit the nail on the head, right? People on this stage invest in trend lines, not data points. And so I think that's a really sort of important piece to think about, right? I doubt, I don't want to speak for the rest of the panelists, but it's rare that somebody comes and we have an initial coffee meeting and then all of a sudden we think, holy smokes, want to write you a check, right? So it really is about that relationship building, and I think more importantly than anything, it's about doing what you said you were going to do the last time we had a conversation. So when I think about sort of what kind of loosens those checkbooks, it's really not only that history and doing what you said you were going to do, but it really is about the follow through and the follow up. And really, I think the other thing that the panelists have said that's really important is it is about fit, right? I mean, you want a VC or an investor, however you sort of think about it, whether or not you go with an alternative funding source that understands your business and that has made a ton of mistakes or watched other people make mistakes in that business. So I think it's really, we're looking for fit in the same way that other people are, and we're looking for a story, right? So whether or not you're an LP or whether or not you're a VC, either way, you're sort of running up the stream or running up the flagpole. This is a trend line that we believe in. Here's our sort of reasoned, data-backed kind of logic behind why we think this particular thesis will bear out, right? And I think it's been mentioned a few times, but VCs are also picked based on their trend lines, right? So to those LPs, and I think that's important to keep in mind. It's not some sort of magical thing. It's just like dating or just like getting to know somebody over a long period of time and building that trust.
Yeah, I think that analog's perfect. It's dating. Don't come to us when you need money. Come to us before you need money, and you can get to us. I mean, I joke, how do I get to you? Do I email you? Do I call you? You get an introduction, because I get about 300 or 400 emails a day at times. You have to get a good qualified introduction, whether it be your attorney, your accountant, somebody we know. There's a lot of technology out there that tells you who we know, and you have to date, because we're not going to decide to marry you after the first date. And then the joke about that I heard somebody else say recently is the good investments last longer than the average marriage. So I want to be pretty sure I want to get in business with you if it's going to last that long.
It's true of startups too, right? You're getting married, you better be in this for the long haul. But all right, so there's an interesting question to kind of wrap up this train of thought and what we're talking about. And I'd love to ask it of all of you to explain a little bit better about what your interest is and your focus on. Is there a Match.com, right? I'm sure you need the introduction, but how do we find that fit, right? How do we know that, I should start with Rajiv because I'm doing this, or I think this way, or I like that thing, or I should start with Chris because I'm in that vertical, or I'm at this stage. How do we make it easier for folks instead of just blasting everybody and saying, hey, whoever's willing to take coffee with me, I'd love to start dating. There's got to be some way to create some efficiency. So what does that look like? What is the fit for each of you is the question.
Sure, I'll start. So we are mostly enterprise software focused and sector agnostic within enterprise software. So businesses solving big business problems, that's our bread and butter. Outside of that, we have a medical device practice that we've invested in a handful of medical device businesses, and we know how to grow those. And then, broadly speaking, we're opportunistic. So even if it's something a little quirky, we just invested in a robot coffee deal. We'll take a look at it. So we're always happy to chat.
Yeah, think of it in terms of 3 parameters: stage, geography, and then whether it's sector or segments or domain expertise that you might have. So stage for us, we're Series A, Series B investors. We don't do a lot of seed investing. We think there's really good people in town who do seed investing to get companies ready for Series A and Series B. I think that's where we can add value as an investor. We like to believe, since my partner and I have both been entrepreneurs before, we can help with some company building. From a geography perspective, we call it Next Coast for a reason. We call it Next Coast. We don't call it Austin, we call it Next Coast, because although we live here, we do go other places, and we think you have to have a referential perspective of what's going on outside of Austin. I won't say the thing I was going to say. There's some funny things you can say about, you can get head faked by being only in Austin. It's an interesting, unique culture here, and if you don't know what's going on in Silicon Valley or other markets, it can work against you, I would think. And then from a sector perspective, my partner and I, as I said, have both been entrepreneurs. We've both started multiple companies, kind of all around the software and internet and technology-enabled services space. We try to apply a slightly different lens to it, where we think of things more thematically. So we've got a bunch of themes on our website. It's pretty dynamic. They change over time. We don't only invest in those themes. And for us, it's kind of, what do we think are the interesting trends that are going on? And that's how we spend our time learning about those things. So one of them, a funny one, is digital natives becoming digital consumers, i.e. millennials. So we think millennials are going to change a lot of different businesses, and so we try to get in the heads of millennials. So if somebody has a business that's focusing on millennials or targeted at millennials, hopefully in that dating period, we would have an interesting perspective on it. So that's our criteria.
Yeah, so I think the trifecta is really important: where, when, and what. For us, it's software and e-commerce. That's it. If it's not software or e-commerce, I'm just going to tell you, like the fast no. Appreciate the fast no, right? You're coming to beef jerky, I'm a vegan, sorry, I'm not doing it, right? Like, that's how it goes down, software and e-commerce. The other thing is stage. We like early. You have to kind of, and this is important, I think, for a founder, there's sort of seasons where you are going to have a trajectory of your efficacy, and it's going to start to wane, right? And then there's investors and advisors you surround yourself that'll also have an effective curve that will wane. And there needs to be a nice baton pass from people that can go from, I've got a product and 10 grand in revenue, to I've got a product, I've got a team, and I'm doing, $1 million a year in AR, taking that to 10 million or whatever, right? There's a season, and you have to walk it up. So we're early in the season. We only do Texas because early means risk. It means a lot of work. It's a grind, right? So the last thing I want to do is fly to Illinois to meet some founders in 2 hours notice. Like, no, I'm going to meet you at Mozart's. We're going to hammer it out. So, close, early stage, and then ultimately we have a bias towards people we know. I mean, like you said, it's dating, right? Like, why roll the dice on people? You don't have to, right? We're already betting on a theme. We think, we're waiting for somebody to come to us and say, you think the hockey puck's going here, we think the hockey puck's going there. I've already maxed out my credit cards and billed it, and I did this 3 times before. Let's get the band back together. That's what we do.
A lot of similarities here with what has been said before. Number one, we are pan-Texas. I think the entire portfolio is in Texas. But that means, of course, the bulk of it is in Austin. But we've got companies in Dallas, Houston, and San Antonio. And we think there are a lot of synergies between these markets. Talent is very fungible across them. So number one is pan-Texas in nature. Number two is predominantly Series A investors. We've done a couple of occasional seed stage investments too. And recently did our first Series B investment. But predominantly the bulk of our money goes into Series A's, where we write a check of $2 to $4 million for a first check. But very importantly, we are full life cycle investors. What that means is we write a first check, and then we are there to be with you through multiple rounds of financing. from the first round of financing to hopefully until promised land. Number 3 is we are active investors, which is we like to work closely with our teams. We make helpful to you guys and help you be successful, which often is helping you with strategy, helping team building, are a couple of things we spend a lot of time on. And lastly, we are intentionally much more people-centric in investing, much more than segment specificity. We just want to looking to back the best companies here in Texas, companies that can be world leaders in their respective categories. And when you're a geographical investor, it's hard to a priori have an opinion as to these are the segments I want to invest in, because you just might not find the best companies in the world coming out of those themes up front. But within that, we definitely have a strong preference for things to do with enterprise software, companies solving complex business problems with some differentiated approach. We've got companies in solving problems in real estate, companies solving problems in healthcare. So things where people have a strong perspective about those industries and where they're going, and where they have an opinion about how they can use technology to truly disrupt how these industries function going forward, is a particular point of interest. But having said that, investing ends up being very people-centric in nature. Is this a person that we can see ourselves being in the foxhole through the good times and bad times? There will be bad times, we all know, in any company. But is this a person we can have a long-term, authentic relationship as we go on to building a company? Is, in general, the most important criteria that we look at when we back a company.
So Silverton is seed Series A, predominantly Austin. 80-90% of the capital that we deploy goes to work here. So not super dissimilar from other folks. We're tech and tech-enabled services. I guess the thing I'll say that we didn't really cover is, hey, is VC right in general for your business? Like, does it make sense? Or are we the right people to talk to? And one thing that, everyone talked about the size of the funds and where the money comes from. The expectation from those people, broadly speaking, is that we're going to give them, roughly, 3 times plus their money back at the end of that period. So, if it's a $100 million fund like our last one, people are expecting, $300+ million back. And so we're going to make 15 to 20 investments. So a deal that, where you want $1 million or $2 million and it's going to be 3x or 5x in a couple years, while IRR-wise, you would think that that sounds great to investors. That is not a venture capital deal. If you just do the math on that, we'd have to have 100 of those businesses to kind of deliver the return. So, venture capital really is an investment if you want to try to build something big. It doesn't necessarily need to be $1 billion business, but kind of $75, $100+ million outcome is really what most of the folks up here are kind of looking for. Not every company achieves that, but what the last thing you want to do as an entrepreneur is kind of get crosswise with investors, where you guys want to build a $30 million business and own 80% of it and have a great outcome, and your investor wants you to build a $300 million business and own 40% of it. And so just kind of understand that. I mean, it doesn't broadly change between venture folks, but if you have more modest expectations, that's great. There are a lot of businesses that do that. It's just, the venture stuff probably isn't the right group of folks. So.
Yeah, and I think for us, we're a little bit of the odd duck here. So we, the way we really think about it is we're looking for a couple things. So tech-enabled businesses are really interesting, and the way we think about that, and this is not the future's here, it's not evenly distributed, and there are still plenty of places, and I think that this is a perspective that's easy to lose when you work in the tech industry, that there's still lots of opportunities where technology really has not gotten into a number of industries, and so we're really looking for those opportunities. So how can you sort of, through operational excellence and operational technology, really sort of change the outcome for a particular industry or particular investment? And then along that line, the other place that we see folks that, or we see undercapitalized markets is really in the social impact space. So when you look at that market, there's not a lot of risk capital yet, and there are very few examples of institutional capital providers that are looking for social impact opportunities. And so where we really fit and where we really see our role is really being in that seed stage investment role in places where other people are not really willing to take risk, but again, with the sort of parameters that the other panelists have mentioned. And I think the other thing that's important for us and probably for other seed stage investors is we want to make sure that when we get involved with a business, and this is to Chris's point, right, that there's some place to pass that upstream, right, where, you know, our utility is limited to a seed stage or, you know, sort of approaching an A-round investment. And so we're also, you know, we think very carefully about the ecosystem, and I think that's important from an impact perspective, because you really do need a place to kind of nurture that company or that entrepreneur past what we're capable of as a seed stage investor.
Cool. I have so many more questions about this theme because Morgan's pointed out the fact that we need to deliver returns of a certain size, right? And that's an important question for everyone to ask. But Tom and Matt, you've kind of taken us down the direction of the fact that there's a lot of differences based on where you are and the stage that you're at. So we're going to shift topics. We're going to shift gears a little bit. And so thank you guys for that. Y'all ever been in a studio audience? We're doing the studio audience kind of thing right now where I'm giving pauses for the film crew. So thank you very, very much. Because of Team Austin, because of Impact Hub, we can do this. What we'd like to talk about next, right, is that transition. And I was joking in the back with some folks that I'm literally kind of wearing the transition. I spent 12 years in Silicon Valley, so from the bottom up, I'm wearing Silicon Valley. And I used to work with Sequoia and First Round Capital and those guys quite a bit. And then, you know, from here down, I'm clearly Austin, not Silicon Valley, with the hat and such. Austin's a different place, right? We've got a different approach. We've got a different culture. We've got different industries. We've got different experiences. And so in playing the role of a venture capital fund and in needing to sell what's going on and raise capital, and then are also needing to figure out where there are trends and patterns and resources and other folks that can work with what you're doing. Let's talk about what's going on here. Let's talk about why Austin, right? Why is Austin pulling together 150, 200 people to talk about venture capital funding in particular? And I'm going to start with a provocative question, which is the fact that every single one of you pointed out that you're roughly at the seed Series A stage. So in Austin, what's next? What's the next stage look like? Where's the rest of the capital coming from for us to develop this ecosystem much more substantially? And I think it's a critical question for us to start with because it depends on you guys going to develop that, but it also depends on these folks creating the reason, right, for much more substantial funding on your part. So lead us a little bit, right? In Austin, we've got a lot of seed funding, we've got a lot of angel funding, of course. What are you seeing is coming next for Austin to help drive more substantial funding, to help drive more interest in what you're doing? And since we're not talking so much about what each of you guys are doing, and we're instead starting to talk about the ecosystem, we'll just probably mix it up a little bit. Krishna, you got some thoughts on the future of Austin and how we're starting to pull more capital together?
Yeah, you know, there is a small history lesson here, right? Austin was a big, robust area for venture capital. We had about more than 15, 18 firms operating in the last decade. And then many of them, for a variety of reasons, disappeared. And we went through a big dip in amount of capital availability, local capital availability between 2009 and 12 or so in terms of doing early stage investing here. And unfortunately, you're seeing the effects of that today when you don't have as many deals getting done in those times. As a result, fast forward today, you don't have as many companies that quite started then and didn't raise early stage financings. Fast forward the last 4 or 5 years, look, the collection of us here have all raised sizable funds. And as a result, we are seeing a much more robust early stage activity scene going with the amount of awesome entrepreneurial talent in this market. So I think we all can start to feel better about the Series A gap, which was a giant gap that used to exist, call it 5 years ago, compared to the velocity of Series A activity underway here. But of course, now the bottleneck moves to the next stage. Who's there to do the B's and C's? And we used to have a lot of B's and C guys keep showing up in town in the last decade, and a number of that went down a bit because there wasn't as much early stage activity. But we are beginning to see some impressive deal activity more recently. And it's, as you said, it's up to all of us. We all collectively go recruit. We all have great relationships with the coasts. We continue to recruit people to come and look at good companies here. And entrepreneurs here are thinking big, dreaming big, coming up with bigger ideas, which can go and raise that nice rounds of financing, which the 30, 40, $50 million financings, market opportunities and disruptive ideas to do that. So you're beginning to see the coastal money show up for these things. But the first round of financing ends up being local money, which is because venture is a neighborhood sport from a Series A perspective. And the good news is, I think we have a lot of money to go around. We can definitely take more, but we are slowly beginning to solve the Series B, Series C gap here in this market, which is still very much work in progress.
Yeah, I think that there's one nuance to understand here that the earlier stage you're investing, the closer you need to be to the company, because companies are very fragile at the beginning, and there's a lot of help that they need in order to grow and blossom. And as they continue to evolve, they begin to stand on their own a little bit more, and so you can manage them from a little bit further away. Which is why, if you look at the capital here, we're focused on seed stage, Series A, Series B. The investors from the coast who don't need to be here are now coming in for the Series B's and Series C stage deals. If you look at the data, the number of 20, 30, 40, $50 million rounds that are happening in Texas has gone up exponentially. And so we're really excited about the rest of the country waking up to this thing that we got going on here in Texas, which is that we're 10% of the U.S. economy, we're 10% of the GDP, the population, and we're going to be 10% or more of the innovation here.
Yeah, so Christian and I used to work for Austin Ventures. The last fund was a $900 million fund. We didn't syndicate with a lot of people on early stage. Even with a $900 million fund where we could have funded things all through the life of the company, you syndicate for different reasons other than just the money. You syndicate for the value that another investor brings. When I was there, I invested in 21 companies, 70% of those in Texas, and 95% of the 70 syndicated with firms from the coast for future rounds. So I think the money comes from the coast. It's always come from the coast for the later rounds. Good deals continue to get funded if they need money. So I don't see a gap that's going to exist in our future here.
I really agree, and this is something that comes up all the time. Is where's the growth capital and whatnot? It's there, and if you have a business that's doing well, it's readily available. I'll tell you right now, if you look at the commoditization of the capital stack, the world doesn't need another Series C fund. Like, there are so many funds with 250 to 500 million jumping into no-brainer companies with 3-year exit windows, right? Like, that's the commoditized line up the MBAs, run the playbook thing, right? That's what will find you. That money will hop on a plane and find you. So when there's an absence of growth capital for your company that's doing 5 to 15 million in revenue, it's probably thesis driven. Maybe ask yourself that. Am I in an industry that is hot right now, that capital's pouring into? Do I have still from this point on a clear line of sight to be a big $250+ million company? And if that answer is no, awesome. You build a solid cash flow business. Hopefully you have a clean cap table, which is who owns your business. Talk to a bank, whatever. That is not a bad thing. But I think that the notion of you have a good solid company, you can't find Series B or C money, oh my gosh, I'm back and forth on the coast doing follow-on rounds all the time with our CEOs. It's line them up. They're everywhere. Just get to that point.
Yeah, I guess I would say with the later round capital issue or whatever, you just need to approach it like any other kind of hurdle or challenge that you have with building your business. There are very few BC and later firms that are geographically focused. They tend to kind of go everywhere, so it's not an issue. If you want to raise that, because there aren't people in your backyard, they're not going to be like stopping by every day, so you might need to go to them, or you might need to affiliate yourself with an investor like any of the folks up here who have those relationships who can kind of help you get in those doors. So if you want to raise money from, Excel's growth fund or Insight or whoever, pick a local firm that has worked with those people in the past. Chances are there's a strong relationship there and they can kind of help facilitate it. And if you want it and they don't have it, go build it yourself. And so, the whole, I'm a victim card, the capital isn't coming to me, no one's beating down my door. It's Austin isn't disadvantaged. In fact, it's more advantaged than 98% of the rest of this country. So it's a very solvable problem. There are people who have done it here very successfully. So it's just something you have to put some effort into.
Great point. What I love in the point you just made, Morgan, is that you play the role of the great connectors, right? That the conversation should often just start with y'all, right? And maybe we're not ready to raise money with you yet or fund you yet, but we'd like to start the conversation. We'd like to know where it's going. We'd like to help you figure out how to get funded. We'd like to help you get more funding in the future. And so what I'm curious about, Matt, maybe you could share some thoughts first. What I'm curious about is, we're all moving here. A lot of us are moving here, myself included, for a reason, right? There's no question that the future of what's going on in this economy is in this part of the world. Why? What are we seeing in Austin that's particularly interesting and exciting and fun? What do you guys like? I love how Chris pointed out a focus on e-commerce, because I've seen the same thing. We've got an exceptional amount of e-commerce and e-commerce strength in that particular niche in this part of the world. What do you see?
Yeah, so I think just to go back to one other thought about this kind of perceived capital gap that people, I hear a lot of conversation about this. I also think that there's a lot of people that have recently been patting themselves on the back thinking that they're smart about how venture is really rising in the middle of the country, right? And there's, you could go on VentureBeat or TechCrunch and you can read an article every day about how the middle of the country is the new Silicon whatever, Silicon Island, Valley, River, go, pick yours, right? And I think that what's important to remember is that Austin's at the top of that pile, right? And we have been, I think, for a very long time. We're sort of the king of the rest, right? Other than the coast. And so I think too, just kind of keep that in mind, right? As you see money pouring into places like Columbus, Ohio, or St. Louis, or the A-round funds are launching constantly. I think that Morgan's point is really well taken, that we're way ahead of a lot of other folks, and I think that a lot of people are sort of looking for us as sort of the leader of the rest. But in terms of what we're seeing here in Austin that I think is particularly interesting is that I think people come here because they're square pegs in wherever their round hole happens to be, right? So you might not perfectly fit into the San Francisco venture world, or you grew up in the middle of Iowa and you're going to go to the biggest city that is close by, which is either Austin or Chicago, right? And so I think that what you're really starting to see, and where I think that the value of the ecosystem is really in this diversity of thinking, and the fact that 160 new people are coming here every day. And so I think there's sort of a willingness to embrace new ideas and new people, and I think that there's some emergent properties of that kind of melting pot that I think are really exciting things here in Austin, and I would also extend the conversation to San Antonio and some of the other Texas markets. I don't just think it's about Austin. There's a new cryptocurrency fund that's launching out of San Antonio, so I think there's a lot of really interesting things that are going on here, and part of what I think the sort of lack of awareness there is that Texas is a little bit of an old school state, right? There's a lot of bootstrap businesses, there's a lot of oil and gas money that becomes the LPs, and so there's just a slightly different approach, and I don't think it's a good thing or a bad thing. I think you just need to be comfortable with the fact that you approach it just a little bit differently. There's not, the $10,000 mural on the wall of an A-round company, because your investors would be furious about being that profligate.
Sure.
Yeah, if I can say one thing, I agree with everything you said. I was on another panel for the Kauffman Foundation recently, and it was a comparison of all of the second tier markets. Not that we're second tier, but we're classified as second tier. So all the second tier markets, so like Austin, Madison, Wisconsin, Chicago, Minneapolis, and just what's the history that got us to where we are. And this is timely because ACL's coming up, and I always joke when friends visit and we are like, oh, I've never heard of that band, they're awesome. It's like, yeah, Overnight success, 30 years in the making. And that's really what Austin is. If you look at the history, we got to where we are, and everybody wants to recreate Austin, all these other places in the Midwest that you referenced. It's like, how do we become the next Austin? It's like, it'll take you a while. It'll take you 20, 30 years maybe. Because if you look at what's happened, it's the university, it's the state government, state regulation. It's a very friendly business state. A lot of successes that happened 20 or 30 years ago are still feeding this ecosystem. Somebody mentioned Tivoli earlier. We have a lot of people in our portfolio that amazingly worked at Tivoli. Trilogy, huge. Trilogy, Austin wouldn't exist if Tivoli and Trilogy didn't exist, I don't think. Or at least this ecosystem wouldn't exist. Our former firm, AV, wasn't perfect, but man, we put a lot of capital to work here. Bill Wood, one of the founders of AV, started Silverton. So there's a lot of history that's gotten us here, and now it's up to everybody in this room to continue it and make it better for the next 30 years, I think.
And to pick up on that's, I think, really changing things for the better for everybody, is that we are manufacturing a lot of smaller exits. Now, granted, we talked about that. That's not necessarily a good thing for VCs, but it's an awesome thing for the ecosystem, right? Because you're getting your first W, right? You've built a product, you've hired some teams, you navigated an acquisition, right? That's a really important part of it, is just birthing success, and that's what the Silicon Valley did, and it's why they're a juggernaut, right? So it comes in all shapes and sizes, because once you've had a $25 million company and done that fist pound, right, you don't want to have another $25 million company. And we've got an exit right now in our second fund, which we launched in November, right? So that's not the game plan. Like, our job is not to put a little bit of money out and get, 4x back. Like, that's not how we scale it. But what happens is now there's a high five, some people are made millionaires, they go hang out inside this public company, find out what they suck at, and then guess who the first phone call is, right? So that's kind of the angel way to do it, but these little things turn into big things, and who knows what that next company those people do is, right?
I guess the only thing, there are a couple knocks on Austin, and you could argue about kind of whether they're legit or not, but one of them is like, hey, it's a lifestyle, like, people are here because it's a lifestyle city. And they don't really want to build big things. They just want to sell something for $75 million and, hang out. And, if you sell something for $75 million, you're, big cheese here, right? And so, whereas in the Bay Area, it's kind of like, okay, you can, tend my shrubs. I just sold a business for, $100 billion.
You saw what the Apple House sold for?
Exactly, right? And so, people can knock out like, oh, that's just greedy, and that's plenty. It's like, I'm from that area, Silicon Valley. Like, I want that for Austin, and people will try to everybody in Silicon Valley, they're just looking for the next hot thing. They jump ship, they do whatever. Well, it seems to be pretty efficient in terms of like allocating talent to the things that are really kind of taking off and building big things. And like, you could say that that isn't good, or it isn't fair to the lesser companies, but it's built some really big stuff. And so Austin has created some pretty successful big companies. I don't think it's entirely founded, but like, who wants to build the next one, and who wants to turn down the $200 million offer because they believe they can build a $2 billion company, and who wants to not sit here and say, oh, well, I don't want to be super aggressive because I'm worried about like where the Series B is going to come from and like who's going to do that. Who wants to just say, I'm building a great thing. I'm working with great people. I'm perfectly happy conducting that story to it and getting investors excited about it. And obstacles be damned. Like, I'm going to go do this, because like those are the people that like I'm super excited about working with, and those people are here. And the more of those people we get, the more kind of inbuilt culture there will be is like, okay, well, I don't want to stop at 100 million because so-and-so and so-and-so that I, was in the Capital Factory class with, or the Techstars deal with, like they built something big, and I want to be like those guys, because that's what's going on in the Valley right now. And we have that a little bit. It's just, let's take it up a notch, because I think that talent and that ability is here. So.
Do it. Anything else?
No, I mean, the other thing is, I'd say, the other thing is like, it has like I've been here 11 years, it has collapsed to Austin. You know, like it used to be more stuff going on in Dallas and Houston, and it has collapsed to Austin. And like, in my opinion, like that's great. And the reason why that's great is because to build $1 billion company with like 3,000 employees, there need to be 3,000 like qualified people. And if they're dispersed in, you know, West Texas and Dallas and, you know, like that ecosystem, that critical mass doesn't exist. So to some extent, we have to be selfish. I mean, Silicon Valley didn't start with like Sacramento and Fresno and, you know, like San Diego, right? It was Silicon Valley. And so we need to, you know, collapse to Austin and build something.
No, but here's a question that's kind of related and ties a thought that I'm hearing together. Chris made the good point that it's wonderful that we're building $50 million, $75 million companies and exits. It really is, right? Because you got to start somewhere. We got to have some wins. And my experience, and I know some of your experience in the Valley, was that those early wins, that early startup graduate degree, right, was actually just going to work for Yahoo or AOL or Google, and you cut your chops there. And then you've got a network, and you've got some folks that can invest in you, and you can start your first company. And Tom, you pointed out that a while ago we had that with Tivoli and Trilogy. So here's the question: in Austin's future or present state, what are the companies? What are the other resources? Maybe it's Capital Factory. What are the, you know, is it HomeAway? Is it what are the companies that are helping us develop this future of bigger companies? Barbary Bruner from the Austin Technology Council talks about a lot of those, right? The Funware and Silicon Labs and these big companies that the startup ecosystem doesn't necessarily talk much about because they're big companies. But is that a proving ground? Is that where you cut your chops as an entrepreneur? Is there some way to see what's going on in Austin by way of the really cool stuff that's going on at IBM? And how they're probably a great set of future folks coming through there, so that these people, so that the entrepreneurs can figure out where to connect with folks today because of something else we talked about and what we'll talk about in the next segment, our last segment, because of the fact that the best way to start a conversation with you guys is to get an introduction. Well, it's an introduction from somebody relevant to what they're doing and working in the same space. What are you seeing, Krishnan?
You know, there is plenty of critical mass of talent that comes from many of the places you talked about. We have places like, let's not forget Bazaar Voice. Let's not forget Yodel doesn't get enough credit here. We have some amazing people who have started great companies who are Yodel alums, and then a lot of talent within Yodel that are here. So you got one collection of talent, and we have enough talent for the local pace of active investing, who come out of a variety of good companies here, who have learned the chops in those places on how to think about opportunities. Number two, we have lots of talent migration happening from all over the country. It used to be, you know, I've been in the business now for 17 years, 18 years now almost. It used to be incredibly hard last decade doing a search to get somebody to move from California to Austin. You have to convince them, gosh, please move to Austin, there's enough interesting stuff. It's the exact opposite. Search firms want to take a bunch of searches for an Austin-based company because everyone wants to move here. You've got a lot of execs who just pick up their bags, move with their families, tired of living in California, and move here. So you got a lot of execs here in town who we have backed and who have are execs in companies who are actually got their learnings at the Yahoos and AOLs and Googles in the West Coast, who are now here as next generation execs for our companies. So that's number two, is a lot of people in that. And number three is a lot of people in traditional industries who are coupling themselves, who have had entrepreneurial careers in large companies here locally, who have now coupled with one of these smart techie guys and have started companies. That's a very common trend here, where you take tech meets traditional industries, and we've got people in healthcare, people in real estate, people in legal tech, who all came out of those industries but have now morphed to be great techie entrepreneurs with the right kind of talent surrounding them. So you throw all these things together, you know, we aren't no slouch at all in terms of the level of good quality people around whom you can back and staff these companies. And it's plenty and more for us to have a vibrant system.
Yeah, I think kind of following on to what Krishna said, there's also a structural shift that we've gone through in the past 5 years here in Austin, where a lot of Silicon Valley companies are actually building second headquarters or significant amounts of moving significant amounts of jobs to Austin. You know, you've got Apple bringing a bunch of jobs here, Facebook, Oracle, you name it. At Google, everyone's investing quite a bit in Austin as a community, and that's going to be really important as well. You know, part of the risk that you guys as entrepreneurs take on that is when you start businesses is what happens if it fails? Can I go find another job? And now with all of these other corporate jobs around in interesting companies that are doing some interesting things, yes, they're bigger, but they're moving significant talent and operations here. There's less of a risk of, well, am I going to be able to find a job in Austin? Which I think is really important.
You know, I think too that one of the other industries that people don't really talk a lot about in Austin is consumer packaged goods, and I think that's important from an investment perspective. You know, we can focus on tech in the VC world, but you've got Kavu Venture Partners here. I think SKU is an incredible incubator, and I think one of the trends that you're seeing is you have more of these bigger sort of older companies is that they have to buy innovation, right? And I think that Austin's really benefiting from that in the CPG space in particular. And we've just got an incredible amount of talent from Sweet Leaf Tea to Deep Eddy Vodka. So there's a lot of really interesting opportunities here. And I think that one of the things you're seeing is, and I think what makes Austin so special is that all those people are giving back, right? They're becoming mentors. They sort of, you know, they pay it forward in that way. And so I think it's important when you talk about the big companies, and I love Krishna's point about Yodel too. They don't get anywhere near enough credit for the number of alums and businesses that they've spawned. But I think there's also, we need to think more broadly about that because there's a lot of transferability between some of these other industries and some of the things that we're funding, right? Especially when you start talking about the tech-enabled space. I think it's just important to keep in mind that there's more than just tech out there from a VC perspective.
Yeah, the only thing I can add to that is everything you guys just said is the university ecosystem. When I lived in Silicon Valley 12 years ago, I knew a lot of people who went to UT, and when they found out I was moving there, they're like, "You lucky bastard, you get to move to Austin." And it's like, really, is it that good? And so they all, when they graduated from UT, there weren't any jobs they could actually get here, so they moved to Silicon Valley. Now, with everything you guys just described, there's a lot of opportunity for people to stay here. And frankly, it's a really easy recruiting trick to recruit someone who went to UT that lives out there to come back. It's the number one filter on my LinkedIn to look for people for executive positions. But yeah, so they come, and then they want to come back too if they leave.
Good. All right, let's wrap that. Let's wrap that segment. So thank you guys very much. And I know we're getting restless. This is a long talk, so thank you all very, very much. I want to thank Impact Hub again. I want to thank Team Austin again. I think our next segment is going to be real quick, because if you think about it, there's just one question. How do I get funded by you guys? So my name is Paul O'Brien. Thank you all so much for talking about what's going on in Austin and the venture capital ecosystem, what the future looks like. We'll pick it up from there and ask that very simple question, which is an open question, so it's a greenfield kind of answer. It's probably the reason most of us are actually in the room. I just need money. How do I do that? What's the conversation look like? What do I send you? What do I have to have prepared? It's an introduction, sure, but where do I find the person that's going to introduce me? Give me a sense. Give us a sense for how to know that I should start talking to a VC in such a way that it's valuable for you, it's valuable for me, and we can likely result in something. You want to start, Chris, since you started early?
All right, sure. So internally, we kind of talk about Fight Club. Anybody a Fight Club fan? So we're out, we'll find you hopefully, but if not, you can find us. It shouldn't be that hard. Like you said, there's web everywhere. We're not elusive, right? If you're not talking to us and we're not talking to you, you might want to challenge your own business development prowess, right? So consider that a test, right? I mean, really. But the big thing is that to talk to us, is there's a certain amount of risk that's appropriate that you as an entrepreneur take for throwing your hat in the entrepreneur ring and not keeping your day job, right? There's crowdfunding. It's never been better time to be an entrepreneur than ever before. You can have customers pay you ahead of time. We used to have to focus group stuff, like build it and hope and then poke and prod. You know, get out there, check it out. The Angel Network, I mean, Han, which is Houston, and CTAN, which is Austin, are two of the largest angel networks in the whole country, right? So there's plenty of capital. I would say the way to find us is look at what we do, look at what we've invested in. You know, we kind of told you, you know, it's e-commerce and software, and then what stage we're in, and build something compelling and come talk to us about it. We're around, we like to help. Talk early, it is a dating sort of conversation, but we're gonna give you the fast no. The one thing that nobody really talks about being VCs, and I think the Austin crew is pretty helpful, but you don't have to be that bright. In the later stage you are, the less bright you have to be, right? Because it's just pattern recognition and throwing resources together, and 90% of it's timing, well, 80%, right? So really think about that. You're just going in there, and if you're a relatively smart individual and you're getting pitched by 5 machine learning Jedi every day, you're gonna know a couple things about machine learning just through osmosis, right? So just know your investors, what they've invested in, and what can they do besides money. The whole notion of I need money, I talk to a VC, if that's what they need, like, that's not our deal. I'll refer you to them, or CTAN. If you need just money, I'm not your guy, because that's the wrong answer for what our strategy is. Right? If you need co-founders, if you need customers, if you need seeing around corners and some maybe money to do that, that's our bag, right?
But give me some more, because what you're pointing out is that there is something in particular that isn't just money, right? That folks should be looking for from you guys. So what is that? What is that in your case, right? There's a reason somebody's going to invest in a company, and it's not just to write a check and get some money back. Right? Morgan, what? Somebody comes to you and says, I just need $250,000. And is that enough?
You know, at the end of the day, you know, VCs are, you know, they're capitalistic enterprises and everyone's looking for a return. You know, so the real question is, you know, if it's money and not any kind of passion, like, is that, you know, despite that we're financially motivated, is that the person that's going to deliver that financial result? And I think in most cases it's not, because there's always times when, you know, the company financially isn't doing great. I mean, almost by default, when you're starting out, you're not in the position that you want to be in. And so how do you convince, and you want to hire great people, you want to talk to important people, you want to get customers, so how do you get that done? And a big part of that, at least in my opinion, is the passion of the founding team and the founder. So, you know, you have to get people excited when there's really nothing at that point to get excited about other than a thought or a piece of paper with some stuff written on it. And that comes from somewhere. For everybody, it comes from somewhere. And so if it's just like, you know, I want to be rich, you know, the challenge that I would have is, like, what happens if shit hits the fan and it doesn't look like you're going to be rich? Like, do you just stop? Because at some point in your business, like, that's probably going to happen. And if that's your motivation, then, or someone comes to you and says, oh, you know, why don't you just go take a $300,000 a year job at super cush, you get the money, you know, like, that's a risk that I don't want to take as an investor. I want the motivation to be broader than that. And it may, at the end of the day, like, I want to build a big company. I want to, you know, wealth is also an attribute of what I want to do. Okay, that's fine. I mean, I think that's true of a lot of people, but it has to come from somewhere else. And so, you know, that has to come across when you're pitching investors. And if it doesn't, you know, maybe some people would be interested, but, you know, that's an attribute that we definitely look for.
You know, our favorite trait we look for, besides what Morgan said about passion here, is what we call authenticity, which is when people come and talk to us, we all recognize for these early stage companies, there is a long list of things we don't know. We don't know if the product's going to work. We don't know if the customer's going to love it. We don't know even if customers love it, are they going to love it for a long time, or this going to churn? We don't know if you can build a sales force that can efficiently, scalably go to market and scale and be a good business. There is so much we do not know. But we probably know the entrepreneur, you probably have some conviction about some things and not as much conviction about others. I think a big turnoff is a lot of hand-waving about many aspects of the business, as opposed to an honest, self-actualized, authentic perspective on what the entrepreneur knows about and does not know about the business, and how you're looking to take the monies you're trying to raise as a part of the round of financing to go de-risk a few things. What are the most important problems you believe that need to be solved today? And can you have an intelligent, thoughtful conversation about that in that meeting? I think that's probably one of the most important things we look for in a meeting.
Yeah, I think authenticity is is really one of the most important traits that we look for. One of the best things to hear in a first pitch meeting is from the entrepreneur is "I don't know." If we're getting to that point, then there's a lot of things that we all don't know in these businesses. I think Mike Tyson said, everyone's got a fight plan until I punch him in the face. And we're going to go through a bunch of ups and downs together and near-death experiences. And if we can be honest with each other in that first meeting, then we're going to set off on a great path and date a little bit and maybe get married at some point.
Yeah, intellectual honesty is the term we use for that. It's just be able to say, I don't know. But I don't know about you guys. Actually, I do know. But how many deals do you guys do a year? Like, we make 2 or 3 investments a year. So what does it take to get our money? You got to rise to the top of 900 other things that we look at for the year to be the top 2 or 3. And it's not one variable. Sometimes it's, wow, that is a great entrepreneur. There's great entrepreneur market fit. They're going to figure this out, and we'd be lucky to be in business with them. Other times that's a great business plan, business model. I know a bunch of people who could help this person. Let's get them there. So it's not a simple formula. It's just, that's why it's dating. It's a lot of variables go into this equation, and I wish I had a simple answer, because if I did, I'd probably go back and be an entrepreneur again and raise a bunch of money.
Yeah, and I agree with everything that everybody said. I think the other thing to keep in mind is that metrics also tend to raise money, right? So if you have a clear line of, you put $1 in and you get $2.36 out, and here's why, and I can tell you that story up and down, and when you ask me a question and I don't know the answer, I'm going to be honest and tell you. I do think that's a lot of what we see, especially with the first-time entrepreneurial crowd, right? Is that the metrics really do matter, and telling storytelling is good and authenticity is good, but being able to tell it in a believable way, I think is something that maybe people take for granted, or that's really sort of a differentiator, right? It's there was a company that pitched us not too long ago that had deep experience in waste management, right? And that was pretty darn compelling, because they had spent 20 years in what was effectively an unglamorous business, and were just banging their heads against the wall thinking, I could do this better for a couple of decades, right? And so those kinds of, I think that's what we specifically mean about authenticity is, that there really is that kind of passion and that deep experience. And then again, the metrics are also, I think, quite helpful in addition to the entrepreneur themselves.
And just the hand waving and the buzzwords and all that kind of stuff that was mentioned earlier, I think there's a lot of misdirection going on right now. So this is something you may not necessarily hear. I think it's really important to take this town to the next level, is like the bitter, honest truth. Some of these incubator type, like everybody sitting on a big bag nodding along, right? There's groupthink there. There's a lot of misdirection there. You know who knows? Your customer knows. Spend more time with their customer. When I meet a founding team, and they can take me deep down the customer journey, the industry, show me data. That's better than here's the who's who of mentors and this exit over here and look at this comp and blah. That's all noise, man. Like, tell me about your customers, why because it's the first phone call. We're gonna do due diligence on your customers, right? So that really shows a couple things. It shows that you're smart enough to find out who pays your bills, take care of them, and then it's all about how big can this thing be. But who's on your cap table and who your mentors are and all that, absent customers and knowledge of your industry and where you're gonna go, is just kind of useless to an early stage VC like ourselves.
Great point emerged. And I got one more question, just to level the room. Great point emerged there that I want to reiterate, and it's the idea of being honest, the idea of having a problem that you have to overcome, right? Knowing what the gaps are in what you're doing. There's a reason you guys are investing, and it's to overcome something. It's to help address something. It's to help build a bigger company by way of you being involved and being able to bring some resources or talent or capital to the table. A long time ago, one of my early venture mentors pointed out that a venture funding pitch is not a sales pitch, If you're selling your thing to me and everything is perfect and it looks good and it's ready to go, well, then what do you need us for, right? So the question is, the one question, and we're done, so thank you guys. The one question, we'll make it kind of a fast answer. What's the one thing that you would like to see the Austin ecosystem, this room, startup entrepreneurs, make sure that they're bringing to you? Whether maybe it is a cap table, right? Just since you brought it up, Chris, right? What's the one thing that folks should really absolutely focus on that maybe they aren't doing so today sufficiently? You'd like to see more of, or you're seeing that we generally have a gap in marketing or sales, and dang it, if y'all would just focus on that, we could fund more companies, or give us the one thing that you think really could make a substantial difference. Big picture for everybody in the room. And then we'll wrap. Krishna.
Not big picture, I'll give a small picture. Because you build companies brick by brick. So at least, I think what we would tell every entrepreneur, every one of you, when you come and talk to any of us, is you're working on you're passionate about an idea, you're working on something. Talk about what about your journey, your life's journey, that's contributed to the insight you have. We really want to talk about that. You have a certain perspective on what do you want to tackle, what problem you want to go after, or maybe the problem you want to go tackle in the first place is something that's directed by your own personal experiences, your personal journey, right? I strongly urge people to lean on your personal experiences to come up with the right kind of companies you want to start in the first place, and then along the way as you make progress and learn from those experiences, be prepared to talk about how those set of experiences and your life's journey makes you uniquely qualified to have that insight to be to have started that company.
What problem are you solving? How are you going to make money at it? I mean, that's just keep it simple, right? That first meeting is, why are you the right entrepreneur to do this? What's the problem? Why are you the right one? How can you make money at this? And what's it ultimately going to end up being?
I think you guys covered it.
That's it. Passion and problem.
Passion, yeah. Make sure you're solving a problem, and your goal in that first meeting is to continue the conversation after that first meeting. And so, just have an eye towards that and be authentic and passionate and care about your business, and you'll continue to do well.
I mean, I think one of the things that's commonly underrepresented in a pitch, I mean, there's a thousand things out there that tell people how to pitch a company to a VC, but a lot of times people don't talk enough about the team. And not just themselves, but who else on the team. And there's no greater social proof than other really smart people who are super talented, who have a lot of other options, like choosing to do your thing. So talk about them, talk about how great they are, talk about why they joined you. That's a big one. And then the other one, a lot of people talk about, investors look for risks. You got to identify the risks and mitigate the risks. And albeit that true, I think one of the things is that people don't necessarily talk about enough is well, what could go right? If things worked out, what's unique about that business? Do you have some network effect that makes it, impossible for someone to compete with you or very costly to do so? Do you just have, is it, some technology that no one else can reproduce? People call it barriers to entry and that sort of thing, but it doesn't necessarily need to be, a particular technology or anything. It'd just be okay, well, if everything kind of worked out in the way that we talked about, why is this company unique? Because if you looked at the really big outcomes out there, they all created something that was differentiable, unique, and sustainable. And so, talk about that, and do some thinking about why that is before you come in, because at the end of the day, like I said, we want to create big outcomes, and big outcomes have certain characteristics. So identify what those are in your business and be prepared to talk about them.
One thing that I've seen that I think would be great to have more of this is self-awareness in founders and know your limitations and be open, kimono, and articulate those right up front. Like, these are my limitations. I struggle with this. I may not be the gal for this. I might not be the guy for this. Like, just throw that out there. I mean, it's a partnership, right? You know, come clean. That's fine. We're all human. And the other thing is I think there's a rampant sort of situation going on of people that aren't technical founders starting technical businesses. Get a technical founder. And if you're a CTO out there, like, nodding your head, but it's a big deal, right? Like, you're building a product and you don't know how to build a product, right? Big deal. Get a technical founder. There's plenty of people coming out of grad school, reading tea leaves, launching companies. Who's gonna build the product? Not only that, who's gonna lead the team of other builders, right? At some point you have to build a company, and it's not just one CTO or VPE, it's people building technology, and what's that person's ability to lead and not only build?
Yeah, I think for us, I'll go a slightly different direction, which is that everybody on this stage thinks a couple things that they believe are almost certain to be true about the future 10 years from now, right? So take advantage of that, right? So if it's, we have excess capacity in all sorts of assets in the United States, which is, I think part of the pitch that Airbnb or places like Zipcar, sort of use, right? What are those things that potential funder, whether it's an angel or a VC or a bank, are pretty damn committed to in terms of what the future will look like, and then build off of that, right? So if your product, if you have an investor who believes that blockchain is gonna eat the world, well, you should probably have that kind of a business and be anchoring to their thesis about what they think the future will look like. And I think that people miss that a lot, and I think that's sort of part of the money conversation is, it's not just money, but we have biases and opinions and theses, and you should understand those, and then you should tailor, as long as there is a genuine fit, you should tailor that conversation along the lines of what that person is already inclined to believe about the future, and make sure that that fit really is there. Don't go to a blockchain investor or a cryptocurrency investor and just try and wedge your company into that story. That's definitely not effective. But I think it's important to look for that fit and recognize that we all have particular viewpoints and use that to your advantage as an entrepreneur.
I knew it was in there, right? It wasn't just passion and experience. Nice job. Right? That the most challenging thing to do in thinking about venture capital, thank you guys, is that you have to deliver a return yourselves, right? You have to play a role as a partner with these entrepreneurs. And so that requires that folks are honest and experienced and passionate, and they've got a team that can solve problems, and they've got perspective on what the future looks like so that they don't get hit sideways with something that they didn't see coming, and the company fails just because they missed something that was going on. So thank you all very, very much. I want to particularly thank a couple other folks, Golden Arm Media and Only in VR, because my name is Paul O'Brien. I work in Media Tech Ventures, and so I'm very passionate about the fact that we're developing media to help this ecosystem, and so we'll produce some outcomes from this, and we'll foster the discussion further. So thanks to those guys. Thanks to Team Austin very much. How about a round of applause for Team Austin and Impact Hub and the sponsors? And then, most importantly, to you guys, another round of applause, please.